I am Arman FCMB Biligo II from ABMD, and this PETA, the analysis and interpretation of financial statement. Financial statement is the process of evaluating risk performance, financial health, and future prospect of a business by subjecting financial statement data to computational and analytical technique with the objective of making economic decision. So financial statement evaluates a company's performance or value through a company balance sheet, income statement, or statement of cash flows. With the help of the three kinds of financial statement, the horizontal, vertical, and financial ratio, the investors may develop a more nuanced picture of a company's profile. Ratio analysis. Express the relationship among selected items of financial statement data. The relationship is expressed in terms of percentage. In terms of a percentage, a rate, or simple proportion. They are mainly used by external analysts to determine various aspects of a business, such as its profitability, liquidity, and solvency. With this, it can easily determine if a company's financial health is on an upward or downward trend, and to draw comparison to other competing firms. Financial ratio. Financial ratio is composed of numerator and denominator. For example, the debt to asset ratio for 2020, $1,074 as the total liabilities, and divided by 3,373 as the total asset, equals 31.8%. This means that the 31.8% of the firm assets are the financed with debt. Assets turnover is the most important ratio because it tells us the efficiency of an invested asset to create revenue. So profitability ratio. This measures the ability of a company to generate income from use of its asset and invest capital as well as control its cost. These are the most common used profitability ratio. First, we have gross profit ratio. Gross profit ratio reports the peso value of the gross profit earned for every peso of sales. We can infer the pricing policy from the gross profit margin. Next is the operating income ratio. Operating income ratio expresses operating income as percentage of sales. It measures the percentage of profit earned from each peso of sales in the company's core business operation. Next, we have net profit ratio. It relates the peso value of the net income earned to every peso of sales. This shows how much profit will go to the owner for every pesos of sales made. And last, we have return on asset. This means the peso value of income generated by employing the company asset. It is viewed as an interest rate or form of yield on asset investment. Operational efficiency is measured based on company's ability to generate sales from utilization of its asset as a whole or individual. So it is the primarily a metric that measures the efficiency to profit earned as function of operating costs. The greater the operational efficiency, the more profitable firm or investor is. So asset turnover. This measures the peso value of sales generated for every peso of company assets. Fixed asset turnover. It's the indicator of the efficiency of fixed asset in generating sales. Inventory turnover, measured based on cost of goods sold, not sales. Both As such, both the numerator and denominator of this ratio is measured at cost. Account receivable measures the number of times the company was able to collect on its average account receivable during the year. Financial health ratio, company solvency and liquidity ratio. Solvency refers to the company's capacity to pay their long-term liabilities. So this measures whether the business has enough current asset to meet its due debt with a margin of safety. On the other hand, the liquidity ratio intends to measure the company's ability to pay their debt on the upcoming due term. Like what I said. Debt ratio. It indicates the percentage of the company's assets that are financed by debt. Equity ratio, percentage of the company assets that are financed by capital. Debt by equity ratio, it indicates a company's resilience to debt or liability as a source of financing relative to equity. A high ratio may result in high interest expense. Interest coverage ratio measures the company's ability to cover the interest expense on its liability with its operating income. Creditors prefer a high coverage ratio to give them that interest due to them can be paid. Current ratio, it is used to evaluate the company's liquidity. It seeks to measure whether there are sufficient current assets to pay for current liabilities. Quick ratio is a sticker measure of liquidity, only those that are easier to liquidate, such as cash and account receivables. That's all. Thank you.